Welcome to our May edition of the APE Property Investment Series. Can you believe it's May already? We're already talking about the end of the financial year. It's 5 months. It just feels like the year started. You know, for me, it feels like it's a couple of weeks ago and we're already in May. So we're talking about tax because it is coming to that tax planning time of year where you need to finalise your expenses and get ready for the end of the financial year, which is coming up in a few weeks' time. So, I don't know about you, but it feels like I've just done my tax return, Munzrul. Funny that. But tonight we're talking about how to manage your tax obligations through property investment. Disclaimer, this presentation is general information only. It doesn't take your specific investment objectives into account. We recommend you seek the appropriate financial and legal advice for your own personal situation. Just a bit of introduction about us. So it's brought to you by Aussie Parramatta and Rouse Hill. We've been operating in Parramatta for the last 15 years. We've got about 13 staff, very experienced staff though, about 200 years experience. We've been the number one Aussie franchise. There's about 160 Aussie franchises. We've been the number one franchise for the last 5 years. And we've also won some awards, the Australian Broking Awards Best Franchise Office for 2016 and 2017. But most importantly, we're experienced property investors and we're passionate about property. And that's why we're here tonight to help you. And what we say to our staff, we work together with you to understand your needs and use our expertise to make it easy to reach your goals. So that's what we're here about sharing. And I'll introduce my good friend, Munzrul, to introduce Keshab.
No, thank you. I suppose what we say to ourselves is that our value proposition is contributing to your life. So we believe in our mind quite sincerely that when we can contribute on each person that we meet, our business will look after itself. So we've been running about 10 years. So Jeremy is my business partner, Jeremy myself. We've got 2 branches in Parramatta as well as Liverpool. And my personal background prior to it in a couple of larger practice, Jeremy being with us about 10 years. We've got 21 colleagues, and most of our colleagues are in property investments in one shape or form. Jeremy and we are in property investments, and we love it.
Yeah, Munzrul reminded me. Tony's here tonight, so Tony, come up the front, buddy. Tony's been with me for the best part of 10 years, and this month he officially became a partner of Aussie Parramatta. So everyone, congratulate Tony. He's been the workhorse behind the scenes and helped many of you, I'm sure, with files. So, it's our pleasure to have him on board as a partner with us. Deb is also a partner, has come on board as a partner at the same time. Unfortunately, she was in New Zealand all weekend at a karate tournament with her son, so she's a bit tired, so not here tonight. But next time we'll bring her up. So thanks, Tony. Tonight's agenda is how to manage your tax obligation through property investment. We'll go through a bit of a market update. Scotty's going to talk a bit about record keeping and how to keep your records for property investing. And then Jeremy's going to talk about 10 things you need to think about before you submit your tax return. And tax. So exciting stuff, hey? In terms of the market update, obviously, finance continues to be a challenge with the Banking Royal Commission, the focus, and the challenging in terms of getting loan approvals isn't getting any easier. It's probably getting harder with the more scrutiny, and I know my guys, Tony, Christine and the team are pulling their hair out with some of the things the banks are asking for. So be patient if you are going through the process. It's not just you, it's everybody that's having a difficult time out there. In terms of, I just wanted to go through some articles in terms of some of the things that we've see the ripple effects these waves have for coastal boom towns was an article in Domain this week, and it's interesting when Sydney booms, then a couple of years later, these regions outside of Sydney tend to get a boost as well. And places like Kiama and the South Coast, Gerringong and those places were quite flat for a long time. And in the last couple of years, you've seen prices almost get that 60-70% growth in some of those areas. So and you're seeing that a bit with the Central Coast market coming back as well. So just interesting to have a look at that. There's an article today in news.com saying why you shouldn't pay off your mortgage. And that was all about what we talk about in terms of leverage, using your property to invest in growth assets where those assets will grow. And I tend to believe that. And if I look at my own personal portfolio, the amount that my properties have grown over the last 5 or 6 years is enough to pay off the home mortgage. So there is definitely not the way of working for 30 years and making those repayments is definitely not, in some cases, the smartest way to pay off your mortgage. And that's what that article was talking about. The other news was APRA removes the 10% restriction on investor loan growth. So in December 2014, it put these restrictions on. So we've already had these restrictions for 3.5 years. And along with that, it made the banks tighten up their serviceability requirements and made it harder to get a loan and put serviceability buffers in. And the reason that they've removed it is not going to make it suddenly easier for investors to get a loan, but they're happy with the banks and the regulations that they've got in place, that it's no longer an issue. The banks are well under that 10% growth now, so there is no real need for that 10% growth. The benefit it is for your smaller lenders, like your lenders like, for example, HSBC or some of the lenders that have smaller books will now be able to go back into the market and lend more on their investors. For someone like a CBA or an ANZ that have massive loan book, it hasn't really been an issue, but it should open up some of these other players to be able to get back into that space if they weren't previously in there. So that's the other thing I want to talk about is comprehensive credit reporting. We're noticing this has been around in the Privacy Act since about 2014. The Privacy Act changed to allow the banks to report on more information. Do you guys just hand these around for me? There's a couple per row. There's about 20 there. So, and I'll hand out an example of a credit file for you, because some of you may not have seen a credit file before. But the changes on the credit file now, and the reason we're talking about it now is because the government was going to mandate it from July this year, and we've already seen some of the banks start to report. So you'll see on that report that NAB are now starting to report on credit cards and personal loans, the account open date and close date, the type of credit, the credit limit, and most importantly, under what they used to call a negative reporting, it was only reported if you were 90 days late. But now where the repayments are 14 days late, and it'll show your last 2 years' history on all your credit facilities. So all your credit cards and personal loans and mortgages and so forth. So CBA have come out and said they will be reporting all of this by the end of the year on all their mortgage products. So big changes are coming in this credit reporting space. So if you look on the one that I handed out, that client has a score of 707. So basically anything in the green is a good score. They have one credit default. Can anyone see who the credit default is with on that file? So it's with a telco company. And you can see how many credit inquiries they've made. So we've always been able to see when you apply for credit. There goes a mark on your credit file every time you make an application. But we've never been able to see your credit limits, or if you actually proceeded with it. So this isn't new. This is something that has been going in America and New Zealand and UK for a number of years, but Australia is one of the last sort of countries to get on board with this. So what does it mean for you as investors? Because obviously your ability to borrow money is really, really important. So things that you don't necessarily need to have a direct debit or regular payment on your credit card. And we're mortgage brokers, we see what you guys do, and we know that people don't make their credit card repayments on time every month, right? We see it day in, day out when we get their statements. So you need to set up direct debits or regular payments on your credit cards. You can get your credit score and your credit report if you want to see what's on it at mycreditfile.com.au. You can also monitor your credit alerts. So for about $80 a year, every time that there's a change on your credit file, and Glenn gave a good example last night where he was saying that he showed up as a directorship and that went on his credit file, and it wasn't him that opened the company. So it's good to have that monitor on your credit alert. So if something does change, you can get it, you can get it fixed quickly. Is there any questions about that credit reporting, or before we move on?
If you have a look at the NAB one, where it has numerals on the credit card, it will actually tell you how many days late you are on your credit card repayments. I'm not sure what the letters mean at this point, but the numbers will actually be stated to how many days late you are.
Yeah, so, and it'll give you a 14-day grace period. So as long as you make the credit card repayment within the 14 days, it won't report it, but anything above 14 days, it will report. And a point to make, it's only lenders, so it's not going to be your bills, it's not going to be your telco companies. They can't report on the 14 days late. It's just going to be the credit providers. So people you've got credit cards and loans with is the main people who will be able to report. So this is coming. NAB has been the first to go, February. I think Westpac's going in April. CBA said they'll have all their home loan data on by the end of the year. But just be aware of it now and start making repayments now, because there's going to be a 2-year history and it's going to go backwards from once all the data's on there. I'll pass it over to Jeremy and to Munzerl for how to manage your tax obligation through property investment. Actually, Scotty's up next. He's going to talk us through some record keeping. So welcome, Scotty.
Thanks, Ross. Yeah, record keeping. Obviously, talking tax tonight, an important part of that is going to the accountant and presenting your documents to the accountant in a way that suits them and that it suits you in terms of keeping those records. So tonight I'm just going to run you through what I do and how I do it. Keeping your own records or record keeping can be as complicated or as simple as you want it to be. I've seen some very extravagant Excel spreadsheets and some simple ones as well. And you might think mine's extravagant or simple depending on what you use. But what I would suggest that if you're keeping records and you've got an extravagant spreadsheet, as long as you're able to use it, as long as it's not an onerous thing for you to do and that it's not something that you dread doing and you make it easy on yourself, that's fine. But don't have something so complicated that you just don't ever want to do it. So for me, the important things that I'm looking for on a spreadsheet is to be able to see my portfolio in a snapshot and see how it's performing, to be able to see my loans, to be able to see what I need to concentrate on and capture the important milestones of those loans, and to be able to see obviously a spreadsheet that I can hand to Jeremy and Munzerl at the end of the financial year and say, here are all of my expenses, and really try and have a simple way to gauge it. I don't really want to spend hours and hours and hours doing it. I've delegated to my wife. The Minister of War, the Minister of War and Finances looks after it. So so she runs through it, and she's not into property particularly or into finance or anything like that. But it is something that's simple enough that she is happy to do it and follow it, and we've tried to set it up so it's easy for us to do. So I have a spreadsheet, and it's a little bit hard to follow here, but effectively it's got 4 tabs along the bottom of a spreadsheet. And the first one is a simple portfolio document. So basically, the front one covers off the properties, it covers off settlement dates, purchase prices, where the current values are, loan balances, LVRs, equity available, rent that's being received, where that rent's applied, whether it's him or her, annual rent and ownerships. So the ownerships obviously goes further when you get into trusts and things like that. And as you get a bigger portfolio, it's obviously important to be able to see where properties are owned and things like that. But that's just a simple way to say when the properties were bought, what they're worth, what the loans are, who owns them basically, and where the equity is. I really like this, and I didn't design this. This was given to me, and I liked the way that it worked, so I adopted it. I like this one because it's got projected values down here, and it's really just a formula where they've got 3% growth for 10 years, 7% for 10 years, 3% 15 years, and 7% for 15 years. And it shows you where the value's going, and then the value less your loans. So when you're thinking, geez, this is painful, you can look down there and go, okay, well, as long as, you know, I've got the carrot, I know what I'm doing it for, so I like having the projected figures down there. But that's just a real basic snapshot of where the portfolio is. The next one I think is more important than where the portfolio is. It's really looking at loans. And I know I was talking to Ross about it, and Ross has got a bigger portfolio, and the idea of building a portfolio is obviously recycling deposits. And you know, you might grab a deposit from this property for another property, and then you might grab some equity out of this property for a renovation on another property. And unless you're tracking where your loans are and where your funds have come from, it's really difficult to kind of track at the end of the year, what do I apply to what property and how do I do it? So this is a simple way of looking at it to say, what loan do I have? What was the property? When did that loan settle? The account numbers, BSBs, what those loan balances are. So it's all different splits and what their purposes were on one spreadsheet, so I can see that. Where your interest rates are at, so what your interest rates are they fixed or variable? If they're fixed, when does that fixed rate expire? So obviously you can quickly see your fixed rate's expiring on this date, I need to do something with that property. Ross didn't talk about it tonight, but obviously in the market, a big thing at the moment is they talk about the interest-only cliff and falling off that interest-only cliff when all your loans are coming off that interest-only repayment and reverting to principal and interest. So all of the loans, when their interest-only expiry is, so I know you probably can't see it, but this one down here is April 19, and that's the earliest one to come off. So if you're looking at this portfolio and saying, okay, if I need some equity, I'd ideally like to be able to grab it from this property here, because I'd love to refresh that loan and restart that interest-only loan again. That's the one to target. So this part of record keeping is about your loans, and it's about knowing where they are and knowing where your rates are at, knowing if you're fixed, when they're coming off, and knowing your interest-only loans and when they're coming off in a quick, simple snapshot. The next tab on this spreadsheet is really about the settlements. So the first 3 tabs of this spreadsheet you only need to do once, or when there's any changes. It's not like you're in this every month, but this is the settlement figures. So all of these figures are off your settlement letter that you get from the solicitor when you settle on the property, or your mortgage document. So you can grab all of this information from two sheets, and it's there forever. So I know that Jeremy and Munzrel I just give them the whole spreadsheet so they can tab through and see what the mortgage insurance was and when it was paid, because they claim it over a period of time, Jeremy. Yes, 5 years. So that's been claimed over 5 years. So it's important that they can see when did that loan settle, what was the LMI, and they break it up that way. Does that make sense? Cool. So this is the working document. So this document really is just your rent that comes in each month. So the way that we do it is we do it once a month, sit down and do this off your rental statements. So what rent's received, what's the interest on the loan, any other expenses. Simply run it through, do it once a month. So this is your working document when you're keeping records. And this is what Jeremy and the guys work off when they're doing your tax returns, to work out overall, what's the overall rent, what's the overall expenses, and it's a good, simple way. And Jeremy, I think this kind of runs in your columns as well, in terms of how Jeremy works in terms of his
It's taken directly from a tax return.
Tax
when
return.
We look at our tax return, we look at your Excel, it actually corresponds.
Yeah, so it's a simple way. So it's trying to make it easy for us, but also easy for your accountant, to make sure that you're claiming everything that you can, and you're actually putting it in the right columns for it. I should ask for a discount, shouldn't I? Yeah. So capturing all the information doesn't need to be difficult, but I think what I like about this spreadsheet is that it's quite simple. You know, I know it looks a lot, but it's actually quite simple to operate, because you're only working on 1 month column at a time. And I've got all of the other information that I can refer back to if need be. So not suggesting that you use this particular spreadsheet, but I'm just want to point out that it's important to keep your records in a way that suits you, in a way that makes it easy for you to do, and it is something that's not overly onerous for you, and something that you're comfortable to do monthly, and make it easy for yourself, and also make it easy for your accountant, because getting the full benefit of the tax deductions is up to you largely, to make sure that you're tracking all of your expenses correctly as well. So I'll just give you one last tip. All of that information, you get so much paperwork as an investor. You get statements from banks, and you get, I don't know if you're getting rates notices directly to you, and you're getting rental statements, and if it's all coming into your own personal or business email address, it gets mixed up in all your business or personal stuff. So I guess a tip tonight to take away is to set up an investment account. So an investment, I would say, get a Google account, a Gmail account, strictly for your surname investments at gmail.com. And then on the back of that, because it's through Google, you can set up a Google Drive. And Google Drive really allows you to just establish folders. So we've just got a folder for each property. So this is just one property. So they come up, so you've got all your properties just in different folders. And then when you click into your different properties, separate it for yourselves where you've got rent coming in, rates, mortgage documents, miscellaneous, insurance, bills, and your loan statements. Ask all your managers, your property managers, to send everything to that Gmail account. Ask all of your banks to send everything to that Gmail account, and then just clear that monthly. So certainly as you're going through and you're filling out your spreadsheet, file those bank statements in the appropriate folder. As your insurance comes in, it goes into your Gmail account, pay it, put it on your spreadsheet, file it in your insurance for that property. It makes it really, really simple. And in the day and age, like what Ross was talking about earlier, we're asking you for so much information now to apply for a loan. We want every statement. We want every loan, the last month's statement for most lenders. I could send Ross, and the other good thing about the Drive, the Google Drive, is it's on your phone. If Ross wanted a rates notice, I could send him a rates notice standing here. If he wanted a bank statement, I could send him the last bank statement or loan statement from every loan, because it's all here, it's all on my phone. So in terms of building a portfolio and rolling your eyes when the mortgage broker asks you for more information, make it easy on yourself to be able to collate your own information and pass it on to the lenders and the brokers as you're moving forward. So by simply simplifying it and making it easier for yourself, will make it easier for you to keep and continue to grow your portfolio by having good records and making it easy for yourselves and for your accountants. Any questions on record keeping? Confusing? No? All good? Good. Right. Jeremy, over to you, sir.
Manzurul, you're going to join me on this one.
Sure.
We've made a promise to each other. We're going to keep tax very light, very fun, I suppose. And we'll try to keep you guys entertained on such a, I suppose, dull subject as one people would say.
No, but it's a large group to see. I suppose there are a couple of comments which I want to make on the back of sort of the comments from Scott. All the sort of comments that Scott made in terms of the record keeping is absolutely brilliant, fantastic. See, from the ATO's point of view, the Australian tax system is a self-assessment system, right? So what that basically means is that we as a taxpayer, we present to the ATO what our information is without any immediate audit as such. But the assumption is that naturally we've got substantiation for all of it, 5 years, 7 years. Permanent documents, we keep it at least 5 to 7 years after we sell a particular property as such. So substantiation becomes very, very important. So there could be any time, any level of review from ATO, and then it becomes my responsibility, not as an accountant, as a taxpayer. My onus is to provide substantiation for everything. And the stand view, I suppose, from ATO is that it's not so much the common sense. The common sense may say that, well, that sort of makes sense. But if you don't have the substantiation, ATO can take a strong route of saying that it's non-deductible. So just one example, if I may, is that I've got a client who used a concept called a 6-year provision. Now, 6-year provision effectively means that if you live in your principal place of residence, there is no capital gain tax when you sell it. Your principal place of residence is exempt. But once you move out of the principal place of residence, you've got up to 6 years to either select your existing principal place of residence, the pre-principal place, or the new property that you're moving in as your principal place of residency exemption. So you can choose either one of them, right? But the responsibility is up to you to maintain that, yes, I moved in that property, I lived in that property over that many years, yes, I moved out of that property at that point of time, and there is that 6 years period. So I had an instant that a client of mine many years ago has bought the property, used the first-time buyer's grant, genuinely lived in there, so this is as genuine as it gets, and then moved out, lived somewhere else, used the 6 years provision. So when ATO did a review, having to go back and collect some of those documentation, which was about 10, 12 years ago, because the client didn't have those documentation, it was a nightmare, right? The basic documentation that ATO wants, prove it to us that you lived in there. How do we prove it? Our electoral address, our corresponding address, our utility bills, all those things are basic, right? But when it goes back about 10 years ago, that becomes quite sort of substantial. Last comment I want to make before I sort of jump into it is that where the substantiation also becomes really, really important, the record keeping or the track of the record keeping is from an investor's point of view, right? A typical example of an investor would be, say, mom and dad investor. They bought their first property. This is their residential property. They lived in there for a little while and they paid off a portion of the mortgage. Then down the track, they used a portion of the equity of their own home and used that equity as a deposit to buy their first investment property. Over time, that first investment property may increase in value. They used a portion of the equity of the first investment property, as well as the principal place of residence, maybe let's say to buy the second property. Over time, it could be third and fourth and fifth. He might use his portion of the equity to buy property on his wife's name or the vice versa. Over time, we establish our trust, right? So we may use a portion of the equity as a deposit to buy in a trust name. Now, all of those things, technically speaking, are all deductible, right? Because he sort of say, guys, I've used all my funding for investment purpose, everything is deductible, which it is, as long as you create and you leave your substantiation. So as long as you have a chain of transactions saying that you've got substantiation. And there are a few other sort of pitfalls along the way that we'll discuss. But today is all about tax. And I've never seen so many people excited about tax, Jeremy, on a cold night. So
We'll definitely keep it entertaining as much as we possibly can.
So we start with the budget, right? So Jeremy suggested that I look into the winners of the budget, and Jeremy will look into a little bit on sort of, I suppose, not so fortunate ones on the budgets, yeah. So the first winner sort of comes in the average income earners. So there was a reduction on the income tax return, right? So just as a bit of a refresher, what's the income tax that we pay? At the moment, the current tax is from $0 up to $18,000. There is no tax. From $18,200, let's say, up to $37,000, there is a bit of tax, 19%. Then it goes to the next bracket, which is $87,000 and $180,000 for 32.5%, 37%, and the highest marginal rate. So what the budget sort of proposed is that from 1st of July 2018, what they're doing is that they're extending the band, which is the 37%, is 32.5%, my apology, they're extending that a little bit more. So rather than having up to $37,000 at 19% and up to $87,000 at 32.5%, they're extending that to $90,000. Subsequently, they're extending that band a bit more to $120,000 and $200,000. So what that means is that there's just a little bit more sort of less tax, I suppose. But what's also interesting is that more from the corporate entity point of view as well, that the individual, there is a bit of a tax reduction. There is a proposal from the corporate entity that there is a bit of a tax reduction as well. The company tax rate, as you know, used to be 30%, yeah? So it sort of dropped to 27.5%. And what the Commissioner is sort of suggesting now through the budget is that potentially progressively over a period of time to reduce it back to 25%. Now, to me, some of those numbers are very important. Why they're very important? Because as an investor, from our planning point of view, right? So we always used to say that, well, whether we buy it on an individual named Jeremy, whether we buy it on a trust, because we may be entitled to a 50% CGT discount. So if you hold the asset for more than 12 months, you get a 50% CGT discount. And that could be an incentive on the individual. And we used to say, well, the corporate tax rate is about 30%. And even if I'm paying at the highest marginal rate, which is 46.5%, because of the discount, my tax rate is only 23.25%. And the company's rate is 30%. So there is a big gap. But the gap is sort of reducing, right? That's sort of 30% now 25%, as opposed to individual maximum 23.25%. So that's something comes in as a little bit of sort of a planning proposal, I suppose, over a period of time. Yeah. So there were a couple of comments came in on the budget in terms of the seniors to keep what they have a little bit more on their side, access the equity on their home for the retirement, and face a shorter waiting list if they're seeking care at home. One thing which came into my attention quite a bit is a concept called reverse mortgage, right? So reverse mortgage, I suppose, Ross, reverse mortgage being around with St. George Bank for a little while, isn't it?
Yeah, it's been around, I reckon, probably about 8 years now.
Yeah. So what the reverse mortgage does is that, and interrupt me if I may, what the reverse mortgage does is that it allows with a certain very strict condition that you can utilize your mortgage, and rather than sort of mortgage being repaid, the mortgage gets capitalized on your existing mortgage. Yeah. So it's a way of, say, the elderly couple who sort of has big asset with fundamentally not much of a sort of a mortgage left. It's a way of generating a bit more cash flow for them. So that's something that's being encouraged a little bit on the budget side of it. The small business, I suppose the main winning on the small business side of it is that there is a $20,000 one-off deduction for any capital asset being purchased by the small business. So it was supposed to be abolished as of 30th of June 2018. It's now being extended for one additional year. Yeah. So there seems to be a whole lot of contribution, I suppose, is that the school contribution. Jeremy will go to the next page. So there was quite a bit of contribution from a state level as well. And there is a bit sort of a winning from the parent side of it. But what I take a couple of things in here and a couple of things which is not in there is that number one is that where it says that 10 years, 75 billion infrastructure project for various states and territories. Yeah. Once you see the breakdown of it, of what's that sort of a 10-year, and I did a little bit of sort of a calculation on my own, and some of the statistics, what it shows is that over the next couple of years, the expected contribution, and this is 10 years, 75 billion, right? So over the next couple of years, New South Wales is supposed to receive 1.5 billion infrastructure contribution. Queensland is supposed to receive 5.2 billion infrastructure, and Victoria is supposed to receive 8 billion. Yeah. So the question that I ask in my mind that how is that relevant to us, if it is? Yeah, from a property investor side of it, right? So if the investment is there in a particular estate, we sort of naturally expect that, well, the infrastructure is there, the cafe culture is there. So we sort of expect from the infrastructure and the cafe culture is that sort of, I suppose, brings in a bit more sort of the property investment. Yeah. Some of the things which, not sort of on the slide, and some of the things which I say is that there was quite a bit of discussion about Medicare levy in the budget. Yeah. And there was quite a bit of discussion that whether the Medicare levy will increase. So I see that as a winner, that Medicare levy hasn't increased. There was a bit of a discussion on the budget in terms of the superannuation side of it and whether some of the taxes on the superannuation will change. At the moment, the tax rate is 15%, the CGT rate is 10%. Whether that will change, that hasn't happened. There was quite a bit of discussion prior to the budget that whether the negative gearing, whether we would dare to touch the negative gearing. And, well, the answer is that I suppose the government was not brave enough, thanks God. So that sort of helped, right? And also with the tax rate side of it in the retirement phase also stayed. So those are some of the winners, Jeremy.
Beautiful. I'll take you through a lot of the, well, call it the losing side of the budget. And the big one is the rich people, as they say. They didn't get too much. It was a very conservative budget. There wasn't a lot of changes to the rich or the poor, but essentially the rich, unfortunately, we didn't get any benefit. For people earning above $125,000. So keep working very hard, guys. Banking and financial sector, again, they're going to continue to impose stronger penalties for any banking or financial sector, I suppose, organisations which go outside the realm. So that is a way that the government will control dodgy lenders. So again, it might make it a little bit harder from the financing point of view, but I suppose having a good finance team, brokers on your side will alleviate that pain. They are focusing still on the multinationals, so they're going to really try to pinch the big guys like Facebook and Google. They are spending still a lot of time in courts trying to get a little bit of extra taxes from them. The big one is the world of digital currency and digital businesses. Very easy to just slide under the radar if you're a digital business or digital currency. And they are working with all these Bitcoin and blockchain things coming out, as well as people doing digital marketing. So they're trying to keep as much wealth that's been earned in Australia taxed in Australia. They are really trying to get that going. So us as the small taxpayers, we're not the one footing the bill for these large multinational corporations.
Jeremy, I think this digital currency that you sort of say is an absolute minefield in my mind. So we recently done a tax return for a gentleman, and the gentleman has been trading for the last about a couple of years or so. And if one were to see the number of transactions that he does, each event has a potential CGT event as such. So the main point which I want to say in here is that you, to ensure that you have your substantiation for each one of those transactions.
And that digital currency world is changing. The ATO are releasing significant amounts of publications every month on how they're finding new ways to tax digital currency transactions. So again, your substantiation is very important, because if I don't understand it, you don't understand it, the ATO doesn't understand it, they'll take a very, very, very plain and simple approach and say, well, we're going to tax you at this amount until you prove us otherwise. Again, preschoolers budget, it didn't give us, for any families out there, we didn't get a bigger package there to help with the childcare rebate, but nevertheless it still will continue on as they've suggested, but it wasn't the high package that we all hoped for. Another big one there is visa overstays. That's costing the Australian economy quite a bit. They are releasing new laws, new legislations, obviously, to stop that, and again, put more money in the coffers so it can assist us as taxpayers. The big one there, guys, is tax cheats. Black economy. They've changed it. No longer will they're going to start putting in systems and procedures in place where no longer anything over $10,000 as a cash transaction can happen. They are increasing their audit team. They are spending lots and lots and lots of money to build up infrastructure, to employ more people. They've got sophisticated softwares and systems to now catch people with the dodgy claims. People claiming 90% of their phone bill, travel when really they're going to and from work, claiming the internet, claiming the home office costs, claiming study expenses, claiming furniture that we buy at home that we sit on in our brand new couch, but really we're saying that it's an office expense. So they are investing large sums of money to catch people out. So it's very, very important when you are planning and completing your tax return, you do talk with your accountant. Be open and honest. As an accountant with our firm, with our clients, we really dig deep into the client's information to understand if that expense is a deductible expense. Because the last thing you want, the last thing we want as an accountant is to assist you in an audit, because the ATO will always find something. So it's important from a substantiation point of view, again, as Scott mentioned, keep everything perfect, but know what you can claim.
Yeah, and you know, there's a statistics that ATO sort of spent or allocated 130.8 million as their funding over the next couple of years or so in terms of targeting certain individuals at high risk. And the definition of the high risk, very often it comes back to the benchmarking, right? So what is the benchmarking? So a couple of examples on the top of my head, number of examples we can think. So let's say a secretary is sort of an admin sort of a secretary, right? And this sort of an admin secretary is sort of have say 45 grand as sort of the overall income, and she's claiming a whole bunch of car expenses as such. So you sort of say that, well, you're an admin, you're a secretary, you sort of, that's fine. You know, you seems to be in the office as such. Do you really use the car to travel around quite a bit, right? On the contrary to it is that we've got a sales agent as an example, and he's a sales agent, right? So he gets about, say, 10 grand car allowance as such. It's sort of expected that you're supposed to have a car deduction against it. Now, while we say expected, you still need to keep the substantiation, whether it's a logbook ideally, depending on the number of kilometers that you travel, right? So there is quite a bit of funding, about 130 million. So some of the tips to maximise, I suppose, your tax return in sort of the ATO rules. So there's a whole lot of things. So I suppose what we did is that we subdivided that into 4 or 5 different sort of subheadings. So we may start with, in terms of a little bit of the record keeping ongoing, the timely and timely presentation of the information to your advisors. We'll speak a little bit in terms of the potential ATO target. What are the industry that they're targeting? What are the markets that they're targeting? And what are the benchmarking? And what are the data matching? And what does it mean? And what does ATO doing on the benchmarking and data matching? We'll spend a bit of time in terms of knowing when and what to spend your funding on. What does that mean? We'll look into some of the common deductions and then we'll try to explore some of the a little bit more sort of intense deductions, a bit more sort of not so common deductions. And then we might spend a bit of time in terms of a structure. That's a question that we hear all the time. What structure do we buy? Why do we want to buy in a different structure? What are the positive? What are the negative? So we'll start with the timely presentation.
Guys, so again, you've seen what Scott presented to you, and that's exactly as an accountant what I want. I hate shoe boxes. We get the shoe boxes full of receipts, and the first thing I do is... So guys, Excels are important. It's going to give your advisor a very good snapshot into how things are travelling. It's going to give your accountant a very enjoyable time doing your return. I'm a big fan of Excels. I do them, Munzirul does them, and a lot of our clients do them. But it is very important also for your own learning. Big one there is obviously speaking to your advisors, getting the right advice. You've got all that information. People like Ross and Scott can jump into it, make a decision. Your accountant, like Munzirul, can make a decision and you move on very quickly. The last one there is for PAYG variations. So PAYG variations is something where instead of you waiting until the end of the financial year to get your tax refund, you're actually getting a little bit of that tax refund each and every week through your pay. And you can only do an accurate PAYG variation when you've got all your substantiation, your Excels, your records up to date. So for people with, poor cash flow because you've got quite heavily negative geared properties, that PAYG variation can assist you with cash flow throughout the year instead of getting a lump sum at the end of the financial year, which could go to potentially other properties or potentially sit in your offset account. But there are severe penalties if you do understate your income, which means that if you get a PAYG variation in place, you get a large sum of money throughout the year and you've got to pay tax at the end of the year, the ATO can impose a penalty and interest. So without having present information, without having it timely for your advisor, no one can give you the accurate advice.
I suppose, Jeremy, my personal view with the PAYG variation is that we do the PAYG withholding variation if we have to. the comment which I sort of say is that you, as an investor, if you're really that close that you just need that extra $100 or need that extra $200 per week to keep your sort of funding going, I think you really need to look back your entire sort of the portfolio, and you really need to look through that. Are you sort of sitting in that sort of a high risk? I mean, the interest rate could increase, I mean, things happen. You can have the hot water system and this and that can sort of collapse. You might not have the tenant in there, right? So your mitigation is very important. Your buffer is very important, right? And whether you really have to rely on that PAYG withholding variation. I think that to me is a little bit of a sort of an alarm bell. The other comment which I was going to say, Jeremy, one of the risks of sort of that sort of timely and present information to your advisor in the right way, if you don't do it, right, I mean, who knows you're funding the most, right? You do, right? I mean, we may have the technical background, we may have the experience, number of years of experience, we may see number of clients on the similar ground, but there are still things that we don't know of what you may have done. Right, so typical things as we check that when we look through an investment property, have you got 4 council rates? Have you got 4 water rates? Have you got your insurance payment? Is it a yearly payment? Is it 12 lots of payment? Have you got 12 lots of interest payments as such? So all of those typical things that we do. But if you went ahead and if you spent, say, a $700 on a repairs and maintenance, and you paid it by yourself, so it hasn't come through your agent's statement, how do we know it if you yourself haven't provided that details, right? So those are the things, and that's the risk.
Beautiful. I suppose the big one there is audits. With all this investment going into the Australian Taxation Office, they are conducting more and more audits, especially in the building trade, with the implementation of the Taxable Annual Payment Summary Report, which means that all businesses in the construction industry, if you're a contractor, whether you're a company or a sole trader, an ABN, the business that you've worked for will actually send a summary of all the income that they've paid you to the ATO. So in the past, your tradie would give you there, I've earned 55 grand throughout the year, Jeremy. Now we've actually got a contractor summary report to contrast how much money that they've earned. Now, on very rare occasions have I seen, some people in the open world have different amounts to what's been reported on the ATO. Right, so this is how sophisticated it's getting. It's getting extended to other industries as well. The ATO will want to know what all businesses, what all sole traders are earning, because they fear that is the risk, where the risk is. So very important, make sure that you are keeping those records. ATO are chasing people quite heavily. People, what have they picked up in audits for the past? The main things: overclaiming on tax deductions, overclaiming on private expenses, mobile phone records. They really do want to make sure that you are claiming an accurate percentage of your mobile phone. It's very easy to say I use my phone 60% of the time, but are you using your phone 60% of the time? So very important, you are keeping a diary. If you're travelling for work, you keep a travel diary. If you travel with your car, keep a logbook of your kilometres or a logbook of the overall kilometres you've done with inside a 13-week period. So they are really, really cramping down on the type of deductions that we're claiming. With property investors, they've taken away the travel costs for investment properties. They are looking heavily into sundry expenses, whether people are paying for that seminar and 5 people are going, but they're claiming all the ticket in their name. They are really clamping down. So us as taxpayers, as a self-assessed system, we're responsible and accountable for what we show. And it's ATO, unfortunately, run under a different jurisdiction. You're guilty until proven innocent. They send you out a bill, $2,000. You have to prove to them within 28 days that you're innocent. And if you don't get back to them within 28 days, the next letter comes. We're taking this to a debt collector. And if you don't pay, they are garnishing your account. And they have changed the rules of garnishee. Before you had to have about 30,000 plus over 12 months. Now it's $5,000 or more within 3 months.
They're not all bad people. There are good people and there are bad people as well, right? And all of those comments are right. And I went through, I suppose, being in the profession for about 21 years, is that I ran through a number of different audits. And what I've found from my experience, Jeremy, is that whenever there is a review from ATO, ATO always gives you an opportunity saying that you self-disclose in your own review if you found something wrong. And what I found is that many of our clients' case, I can give an example a few years ago, that one of my clients, we don't do their bookkeeping, we do their year-end set of accounts and the tax return. It's a big builder client and being audited. And the client came in saying that, guys, we got audited, we've got everything that we need to substantiate and so forth, can you manage it? And I said, well, we don't do the internal record keeping, so if I need to manage it, I need to do an internal audit. So I went back to ATO and I said, guys, I'm chartered accountant, I'm doing an internal audit. If you allow us, if you've given us a little bit of time, I might just need a bit more extra time so I can do that internal review by myself and then come back to you. And I found that very, very sort of welcoming from ATO's point of view. Yep, go ahead, do all of those. I've done that. And some of the things which I found were exciting. They were very, very different, right? The ABN doesn't make sense. It doesn't match, right? You've got the invoices from a whole lot of different suppliers, but the chronological order is exactly the same. And some of the things, right? So it was not the best. So what we did is that we went through, we identified all of those. We actually fixed the problem. We fixed the problem as much as we could. There was some super issue as well, so we fixed all of those. We sat down with the ATO. In day one, we submitted everything, saying, guys, there are a few things went wrong. That sort of went wrong. Our client has gone back and fixed all of those. And more importantly is that our client has taken system and the procedure so it doesn't happen ever again. And what we found that it was good. And ATO was very, very, very understandable. So my sort of professional, my personal view, professional view is that ATO is not there to get you, right? ATO is not there to get anyone else, right? ATO just says very simple thing, guys, you guys do the right thing, and you know, we'll do the right thing as part of the community as such. So one concept, I suppose, is the reasonable man test. And I use that example quite a bit, that when we claim a deduction, yes, we got to follow through the rule and the court of law as such, but does it make logical sense in terms of deduction? Yeah.
And that's important, guys. And I'm sure you've heard, for any business owners out there, One Touch Payroll is coming out very soon. It's implemented by the ATO. Virtually, when you pay an employee, it's going to automatically pay the super, it's going to automatically pay the PAYG. And again, it's just measures the ATO are bringing in to assist business owners and not to leave their employees stranded. So there's lots of different things happening in that world at the moment. But my advice is, Manzurul's advice would be the same, is be fair. You know, be fair. The tax system, yes, we do sometimes get a bit of refund back on the deductions that we claim, but it's on the money that we've spent. You know, we can't make up numbers out of thin air. They don't exist. That's not the way the tax system works. And that's what all this money is going in to implement, is to stop people doing that. So I suppose they're the big ones. And then benchmarking, Manzurul touched upon it, how it works. Essentially, they've got a whole lot of data from all the tax returns that are lodged around Australia, and they are contrasting you against other people inside the same industry. So if you look too much, you're the tall poppy, they will ask a question, and it's up to you guys to answer it. So very important, you are speaking, you are understanding what type of deductions that you can claim, but also are they reasonable?
So I suppose, Jeremy, if I may ask the question, that from the ATO, sort of the audit and the risk side of it, so we're all property investors, most of us, all of us, right? So from the investment property side of it, what would be some of the sort of the fundamental things which has got a higher level of risk in ATO's mind? When we look through that Excel, which, say, Scott has done with the income and the expense side of it.
So the ATO are looking at a number of different things. So buyer's agency fees, training, seminars, education. They are looking at those particular deductions. Is the training entirely for the property investment journey? So for instance, if you're doing a real estate agent course, does that really relate back to your property investment, properties or journey that you're going through? So a lot of different things that they are looking at. Repairs and maintenance, they are scrutinising quite heavily on the repairs and maintenance for the property, whether it's replacement, being depreciation, or whether it is a genuine repair, like I fixed a panel on the fence, or I replaced all the COLORBOND fence. So these are the things that they are trying to look at, they are picking up, and these are the things that we pick up as an accountant to make sure what's depreciable and what's not. And interest as well.
Yeah.
You know, if you top up your loan, I've seen it in the past, cheeky, they've extracted a little bit of investment, a bit of equity from their investment property, and they went and bought a beautiful Mercedes-Benz. Beautiful.
What was the purpose of the car?
And they tried to claim it as a tax deduction, but you can't. So again, the purpose of the loan determines whether it's deductible or not. So we've got to make sure when we're doing our loans, extracting equity with our brokers, that we are really identifying what the purpose of that loan is for. Okay, we can't buy, unfortunately. I'd love to buy Mercedes-Benz, claim it as an interest against the property, but we just can't. It's not deductible debt.
And I suppose the other thing which I sort of say, I agree with all of those, is that whether the property was available for rent. And that's very important, particularly when someone buys it for the first time. And whether you, let's say that you bought this property for $330,000 in Brisbane and it's a fantastic buy, it's an absolute shibaku that you need to spend $30,000 in terms of the renovation side of it. It took you 3 months. And the question that comes in is that within that period of time, whether the property was available for rent. You may have done repairs at that stage, but is it really a repair? It becomes your initial improvement. It becomes capital. And a portion of that time also becomes capital as well. So all of those things. So what we do, Jeremy and I, quite a bit within ourselves, is that we always cross-check with the last year. Right? We always cross-check with the last year, and that's a good your own a check. So we look through simple thing on the interest as an example. Let's just say that a Mount Druitt property receiving about $400 rent, so it's at 20,000 as being the rental income. We've got bits and pieces of expense, and let's just say that it was purchased a number of years ago for 200 grand. We've got the details. Let's just say loan was about 200 grand. So interest is about 4.5. So it's about 9 grand is the interest, right? So we've been claiming about 9 grand. It's interest only every year. Give or take, increases a bit, lowers a bit. So when we do this year's tax return, all of a sudden when we see the interest has gone from 9 grand to say 13 grand, the natural question that we ask is that why has the interest increased, right? Because the interest rate really hasn't increased that much. And you seem to be with the same bank, and then all of a sudden you've got about 40-50% additional increase of your interest. So you may have taken that loan. Now, you may have done that loan because you've taken that bit of the funding, let's say for argument's sake, to build a granny flat at the back of it on that property. Then that's fine. We can claim that on that property as well as the granny flat. But it comes back to the purpose.
Beautiful. I'll just skim through this, guys, and this is very important for anybody trying to get a little bit of extra tax deduction or maximising your tax deduction. Is just knowing when to spend your money and what on. I'm going through a couple of things at the moment with my properties. I'm sanding the floor and repainting it. I'm doing a little bit of repair work and patch-up work on most of the properties, and I really try to do it towards the end of the financial year. So when the money leaves my account in, say, June, I get a bit of that benefit back, say, in August or September when I lodge my tax return. So I suppose when to do things on your property. If you have repairs that need to be done, don't put them off till July, right? Depending on your cash flow, of course, but try your very best to get all those genuine repairs done before the financial year. Or if you need to spend money on, say, for instance, a laptop for work purposes, which we can depreciate it, don't wait until 1st of July. Try and buy it before 30 June because it just maximises, obviously, when we can claim it and when we're getting the benefit back. Because if you buy that or repair that property in 1st of July, you're going to wait until 30 June 2019 to get that tax benefit back. So a lot of my clients, a lot of Munzeril's clients, we're just running through obviously our tax planning with the larger clients and we're working out, okay, well, when do we start spending the money? And around that June period is where I say, look, if there's a lot of repairs that need to be done to your properties or potential prepayment of interest, if you have the ability to do it, you may have sold a property. It's about trying to maximise the amount of deductions one can get now so you can get that benefit as quick as you can in your back pocket when you lodge your return. So again, just throwing some things off, repairs, prepayment of interest. If you do need to do larger renovations, unfortunately they are not a deduction up front. That's more of depreciation. Again, expenses for work. If you do need to, if you're a sole trader or a company and you do need to buy that vehicle or asset before 30 June and it's less than $20,000, now's the best time to do it because obviously you're getting that benefit right in your back pocket today for when you lodge your return in the later years to come. Munzeril, you've definitely got a couple of examples of some good things where you can spend prior to 30 June.
The prepayment as an example, right? So you raise prepayment of expense or expense deferral. Now the common prepayment is the interest that one pays, right? So it's a interest only and you can pay the interest for next 12 months in advance. You need to work out the timing of when you pay the interest. So a recent example, Jeremy, we had a doctor and his wife, and this year the income is rather high from the doctor's perspective, and doctor owns a number of properties, and next year the income would be relatively modest because the doctor is planning to take about 6 months away, yeah? So planning to take away 6 months, so income would be a little bit modest. This year the income is lot higher, and there was some additional work being done and so forth. So what the doctors sort of proposed, when I said this year, it was last year, 30th of June 2017. So what the doctor sort of proposed at that stage is, why don't I go ahead and pay away a whole lot of interest in advance, and by doing it this way, we bring forward the next year's interest as a deduction this year, and next year we're not going to get all of those benefits as such. So that probably is a common example that you pay the interest. Where you got to be careful is that ATO always sort of says, and that's correct, right? The Part 4A. And Part 4A is very, 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 very important. What is Part 4A? Part 4A, in a fundamental note, it sort of says that as long as you undertake a transaction with a commercial perspective, there is a commercial reason behind it, is why you have done it, then that's okay, yeah? But if you've done it purely because of tax, just absolutely 100% because of tax avoidance, so to speak, then it is fundamentally tax avoidance. And ATO distinguished quite clearly the tax minimization and the tax avoidance as such. So even on that client's case, I sort of asked him the question that, well, I understand that there is a practical reason why you pay off that interest in advance, but strictly speaking, we should be asking the question that what is the practical reason for you to do that? I understand there is a tax benefit, set aside that, but what's the practical reason? So that is sort of one example, right? I suppose typical example, as he said, from an investor point of view, and I'm keep going back from an investor side of it because we are all investors, right? It's the expenses that you pay. All individuals are on a cash basis, right? So we're not on an accrual basis. Now, what does that mean? Cash and accrual basis. Cash basis basically means is that what I pay is what I can claim that as a deduction, provided that it's a genuine deduction. And I'll come back to it, what's a genuine deduction, but what I pay is what I can claim. But if I receive an invoice and I haven't really paid it as yet, because I'm within that 1 month time off that I can pay it, then it's not deductible as such, is what he said.
It happens lots of times. So it's just important you make sure that you have paid that amount prior to the financial year ending. What I'll do is I want to get Manzoor, because he loves talking about tax deductions. Loves it. He's going to talk about basic and in-depth, right? And these are all things we need to know. We all know a little bit about the basic, and the common question we get is what type of things I can claim. And there's just so many things, unfortunately, an accountant just can't tell you because it's really occupational specific. But Manzoor's going to run through, I suppose, some basic stuff, work and property, and then some more in-depth stuff, things that potentially you may not have heard of.
Can I ask a quick question?
Yeah, sure.
About the example you gave before, with the gentleman was expecting to have a lean year in the following year because he was taking 6 months off or whatever. Was the fact that he was having a lean year the following year an acceptable reason?
Yes, very good question. Very good question. So I revert that question back the other way, saying that was there a practical reason for you to pay that additional interest? And if the answer is no, then it's more of a Part 4A potentially.
Yes, I
yeah.
understand.
So more of a Part 4A potentially. In that sort of a gentleman's sort of a circumstances, he didn't end up paying much of the interest in advance. There were a couple of practical reasons why he paid it, but the rest of it he hasn't.
Oh.
Yeah. Look, with the deduction side of it is that we look through some of the basic deductions and we look through in-depth deductions, right? So what are the basic deductions? I suppose basic deduction is that, again, as a property investor, we sort of start looking through. We go back into that Excel. So maybe, Jeremy, if we go back to that prior Excel, that would be a good sort of a start. So there are some basic things, right? As a property investor, so we got our rent as our income, and what are the deduction against the rent? So we've got our natural thing, right? So we look through this. This is purely coming in from ATO. So your advertising, if you had to spend in terms of advertising for your tenant, then yes, that is deductible. Body corporate rate, let's say it's a townhouse, villa, or it's a unit as such, you do pay some body corporate. There could be some community fee. Sometimes it could be a house, but it is in a large community that you've got communal fee. So this community fee would be tax deductible. Borrowing expense, Jeremy will touch that later on, so I might just pass that for now. Cleaning expense, as an example, is that if there is a genuine cleaning expense in terms of your investment property, you've got a receipt for it, yeah? So it can't be that, well, I'm Anshul Khan, I own this property, I just went up there over the weekend and I sort of cleaned it and I want to claim it, $8,000 because I've got a cleaning tender that it was supposed to cost me $1,000, right? So it's genuine, right? It was supposed to cost me $1,000. I spent my own time and I sort of did the cleaning. Can I claim it? The answer is no, right? Because you have spent your own sweat equity, so to speak, or sweat time So you need to get a valid invoice, right? You need to get a valid invoice. Technically, when you get a valid invoice, because spice cleaning, technically when you get a valid invoice, you're supposed to check the ABN of the supplier as well. Because if the ABN is invalid, and how many people check the ABN? Do I check the ABN of every single invoice I receive? No. But we're supposed to, right? We're supposed
We had one story of a poor gentleman, a poor carpenter, was getting the subby to do a lot of his work, and we checked the ABN, and I said, "Oh, you've been spending a lot with Bunnings. You spent about 60 grand with Bunnings." And he goes, "Oh, mate, no, it can't be right. I only buy a little bit of nails, 4B2, and probably one gun here or there." This subby was using the ABN of Bunnings. And there was about 40 invoices where he continued to use Bunnings ABN. So it just goes to show that, you've got to be very careful.
Because see, the rule is, from ATO's side of it, is that you are responsible. That's from ATO, right? So what that means is that technically speaking, before I pay the invoice, I should be going into the, and how do we check it? You can go into the ABR website, right? abr.gov.au, and you just include the ABN number in there. It gives you all the history, right? And if it's invalid, then technically you are supposed to withhold 46.5% and only pay the balance of it to the subby. And if you haven't done that check, technically speaking, ATO can say, well, you know what, that was your responsibility, right? So, yeah. So use your, I suppose, judgment, right, in the sense that can we sort of check every one of them. So, sorry, going back to it, if I may, just a bit more. So looking through, so we got depreciation. Jeremy will touch about that depreciation as well. Insurance, if you paid the insurance expense, then of course you can claim the insurance. The insurance could be two. So you've got your landlord insurance, and you've got your building and maybe even content insurance as well. So any insurance which is directly associated. Yeah. Interest, we spoke about it quite a bit. Line of credit, we spoke about it quite a bit. But the one comment which I want to say is not to mix away your loans, right? So what that means is that you've got a line of credit which is fundamentally being used for buying property on investment number one. And you sort of, well, you do that, right? But then you put a bit of your personal funding in there, in that line of credit. You've taken away a couple of grand, and you bought a portion of that Mercedes with that couple of grand, and a bit of private use, bit of a business use, and so forth. If that is the case, ATO has got the full right to come in and say that they probably will give you still a chance and say, show it to us in a very logical manner with an audit trail that how or what portion of that interest is deductible. Now, the challenge, what it happens is that when you mix away your sort of business use as well as the personal use, the challenge, what it comes through is that the interest is being calculated on a daily basis. So it becomes virtually impossible when you mix away your private as well as the business. So don't do it. In terms of your land tax that is deductible, land tax is one of those rare tax, which is a tax deductible expense. Your pest control, if you've done it, property agent's fee, naturally is deductible. Repairs and maintenance, as we speak, very carefully, sort of differentiate repairs and maintenance with capital. If you're replacing an existing asset, it's a capital, must be depreciated. And if you have done some work on your existing asset as opposed to replacing it, that's repair, that's deductible. Stationery, telephone and postage, absolutely within reason and within logic. Travel expense have been taken away. And what charges are there? So if we go back, so these are sort of some of the sort of the basic deduction, right? So in your mind, the way you should keep your record is that whenever you're spending, is that you need to go back to that checklist in your mind. Is it being directly related with that particular investment property? Yeah. So we raised a couple of these sort of basic, right? So whether the car is deductible, whether the uniform is deductible, and internet and a study and the tax agent's fee and donations, all of those may be deductible based on your circumstances. Yeah. Fundamental to me is to again go back to what is your profession? What do you do? And very often your deduction is being related on the basis of what do you do, right? That is absolutely fundamental of what do you do. Based on what do you do? I've given an example. The car could be deductible or may not be deductible. If you're sitting in the office all the time, from home to work, work to home, non-deductible, right? But from work, if you're traveling around in different places, because you have to travel around, and provided that you've got substantiation logbook, then your car could be deductible as such. Donation, as an example, you raise donation in here. Not necessarily all donations are deductible. I hear that all the time. Manjul, I send lots of donation to overseas to my parents as well, right? Is it deductible? And the answer is no, unfortunately. I understand donation to the parents, but unfortunately no, right? The donations are only deductible when it is deductible gift recipient entity, yeah? And the definition of the deductible gift recipient entity are the registered entity under the Australian rule, and that needs to be in there. So we as an agent, it is our responsibility to check that. We do that. Tax agent's fee, yes. And again, even the tax agent's fee depends on what work have I done. So if it is more on a revenue nature, that is to do your tax return day to day, so it is deductible. So all of this. I suppose one thing, Jeremy, that the study that you sort of raised and the comment that I want to say is that people say that all the time, oh, I've worked from home all the time, can I claim my home office expense? And we use that term very loosely, home office expense, right? So home office has been taken away quite a bit. There's no home office, right? The definition of home office, you could genuinely be 2 days a week, right? At 40% of your time, genuinely working from home. You still, and you may be entitled to claim some of the utility bills because you're using the gas and the water and the electricity and so forth, right? So a portion of the utility you can. That is study expense. But if you want to claim the home office expense, which is more, say, you own your principal place of residence, you say, Manjul, this room is absolutely designated. That is what I do. I work in there 2 days a week, and the kids are not allowed on that room, and that is what I do. Still then, it's not a home office. That means still then, you cannot claim a portion of your interest, as an example.
Number of tests you need to meet. You need to have a sign at the front. You need to be open for public access, and it needs to be a separate entry to the house other than your front door. If you don't pass those 3 requirements, you haven't got a genuine home office.
Yeah.
ATO have said it they've just said it very clearly. We're not going to give you a tax benefit for your luxury to stay at home and work rather than going into an office. So it's a bummer because it used to be that way, but unfortunately it has changed quite a bit as they are trying to really clamp down on what we can and what we can't claim.
I suppose some of the in-depth one, if I may, is that some of those we touched it. The overseas investment losses is the one which I want to raise it, yeah? So if we do have any investment in overseas, in our name, my wife's name, under the Australian rule as a tax resident, and definition of tax residence has no bearing to the definition, well, it has some bearing, but it's independent to definition from an immigration point of view. You could still be a non-resident from an immigration point of view, but resident from a tax based on the circumstances. If you are a tax resident, your worldwide income is to be taxed in Australia at the Australian marginal rate. If there is a double tax agreement, let's say, and in most of the countries there are, then you may get credit to any tax that you paid. So a typical example, I was born in Bangladesh. Let's say if I were to have an asset in Bangladesh, which I don't, but if I were to have an asset in Bangladesh, then if it is being rented, I'm supposed to show that as if it is an Australian property. Convert that with the Australian exchange rate and do that. The benefit, though, is that if it's negative, then the ATO allows you as sort of the negative gearing as well, as if it is a pure Australian property. One is to take that into account. I suppose superannuation contribution, the deductibility of it, the forestry managed investment scheme. Now, this is where I've seen people do crazy things. I've seen, people buying emus to claim them as tax deduction. I've seen people buying cows to claim them in tax deduction. And
these really are legitimate schemes that people have put together. It's crazy.
And this is an example where whether the common sense and the logic sort of prevail, right? To remember the very basic common sense that if I'm sort of spending $1, I'm only getting the tax benefit out of it at my marginal rate. So if my marginal rate is 32.5%, if I'm spending $100, I'll get 32.5%, assuming that I meet all the condition of sort of being it's deductible, right? But I'm still getting only 32.5%. Did I need to spend that $100 in the first place? Is the question that I ask. Yeah.
Beautiful. So the next guys, if we may, I might just quickly get Tuan to stand up, if I may, please. Tuan is the principal of Duo Tax. Lots of changes in depreciation again. I'll only get him to talk for a couple of minutes, but just run through what has changed and is there still benefit in depreciation?
Sure, Jeremy. So I guess a lot of people might know that there's some massive changes with depreciation effective last year, 9th of May, budget night last year. So effectively prior to that night, anyone who bought an investment property that was second hand they would be eligible to claim depreciation on all plant and equipment, regardless of the age of the building, whether it was built in the 50s or 60s. So what they did was trying to put a stop to that. People were over-claiming plant and equipment on second-hand assets, whether it was third or fourth time purchase. So effective from the 9th of May, you can only claim on the plant and equipment if it was brand new, if you exchange on that property after the 9th of May. So that's got some huge ramifications. So you've got to be really careful, and it's just a matter of speaking to your accountant or a quantity surveyor such as ourselves, just to get an idea on whether the property has any deductions. Capital works are still depreciable, so we can still claim that regardless of the age. As long as it's built after 1987 September, we can still claim capital work deductions.
And recently I just saw one of his reports where the property was built in the late 90s, early 2000s. They can't get depreciation on the doors, the architraves, the doorknobs, the lights, but they still were getting about $4,500 depreciation on the building itself, which equated for that particular person about a cash refund of about $1,800 per year. And that went through for the next 15 or 20 years of the life of that property. So there still is some benefit, I think quite a bit of benefit in depreciation, that even with the laws that have changed, people like Tuan and other depreciation schedule companies are still getting a lot of benefits. So thanks very much, mate. Appreciate it. I'll touch on a couple other things. I won't be too quick. Borrowing costs, lender's mortgage insurance. We hate paying it, but it is deductible over 5 years, so make sure you are putting that in your return. And pre-purchase costs. So there are things in the settlement, like council rates, a portion of body corporate fees or water rates that you have paid as part of the settlement. We can claim them as a tax deduction. I'll move forward for Manzurul just to quickly discuss on structures, different things you can buy in.
I suppose, Jeremy, structure is something that we can speak. So I might just touch a couple of very basic things. So the question that I hear all the time, what structure do I buy? Do I buy it on individual? Do I buy it on trust? Do I buy it on a partnership? What trust? Family trust? Discretionary trust? A fixed trust? Is there a hybrid trust? Do I buy it on a joint venture? Do I buy it on a self-managed superannuation fund? Yeah. What is the answer? Answer to all of those is that there is no one answer. Right. Answer to all of those is that it depends on your individual circumstances. And very often when the clients sort of ask this question, I say, all right, let's explore. Let's explore your circumstances. Let's explore the positive and the negative of each structure so that you can see where do you fit and what is the best sort of your circumstances. So I suppose from an individual point of view, the benefit is simple. You don't need to set up anything, right? The benefit is that if there is a negative gearing, whether it's through the depreciation or genuine out-of-pocket cash flow, you can claim it against your individual tax. So the refund is there, right? The benefit is that you get some land tax threshold. In New South Wales in particular, reasonably high, 600,000 in the new year. And each state you get relatively higher level of land tax threshold. The negative though, I suppose, is that you don't have the asset protection, right? You own everything. The negative though, when you do sell it, you are the one who needs to pay the capital gain tax, right? So there is no planning as such. We look into the trust. So trust, there are family trust and there are fixed trust, right? So fixed and non-fixed trust. And non-fixed trust is what we call it family trust, discretionary trust, property trust, whatever way we say it. It's non-fixed trust. So if you buy it on a non-fixed trust, your benefit is you do have the asset protection because you don't own it, you control it. The benefit is that the tax planning, the future tax planning, when you sell it on the basis of the definition of the beneficiary within the trust, you can distribute to a whole lot of people, right? You can distribute to 2 generations down, 2 generations up, generation sideways, very wide pool that you can distribute. So there's a whole lot of tax benefits as such. Negative, I suppose, there is a bit of setup cost. Negative, I suppose, is that in New South Wales, as an example, there is no land tax threshold. You pay land tax from $1, yeah? In Queensland, there is a lower level of land tax threshold. Unit trust, at times, people use it for a very specific purpose, right? When there are 2 family members, 2 different families joining their forces, they might consider unit trust. Self-managed super fund, you must take an advice from your financial planner before you consider it. There are a whole lot of positive, there are a whole lot of negative. What are the negatives of a self-managed super fund? It's complicated. Very complicated structure. You've got the super fund, you've got the trustee company, you've got the custodian company. It is a pain in the neck to establish it and to purchase the property, right? And I say that to all my clients, and during the process they say, yes, no, we really understand that it is a pain in the neck, right? So it is painful. So it's also a little bit costly because you're setting up a whole lot of a structure as such. So there are also a few other negatives. I suppose that if you buy investment property in your self-managed super fund, you can't borrow more than once. So you may have bought it for 400 grand, it's gone up to 800 grand. You can't use a top-up equity to buy it. The negative is that you can't live in there. You can't have your family living in there. You can't have your relatives living in there. Lots of negative. Positive, though, is that you've got the power of leverage. So what that means is that you might have 200 odd grand, whether you can borrow up to 80% maximum, 70%, either way, based on your serviceability. With the leverage, it gives you a little bit of a bigger asset pool, assuming that you bought it in the right asset and the right sort of the attributes, I suppose. It just gives you a little bit of a bigger asset that you can control by yourself. So leverage and the own control, as opposed to it's being investing somewhere that we don't know. Joint venture, I suppose, is for a very specific purpose. Yeah. So what's the conclusion? So if I'm buying a property, my recommendation is that before you sign that contract, run that through with your accountant. Run that through. Give him a quick call. That, okay, Manjul, Jeremy, this is the property that I'm sort of buying it. Which structure do I buy? Jeremy will run through what's your income, what's her income, and what would be, whether we do it on a trust, whether we do it on a super fund as such. If there is any rule of thumb, is there a rule of thumb? There isn't. But if there is any rule of thumb that I must dare comment, is that I generally say perhaps about 4-6 properties on your individual name first. Because by doing it this way, what you do is that you utilize your land tax threshold, you utilize a good portion of your tax benefit, and then potentially move into the trust, is what I say as a rule of thumb, if there is. As a rule of thumb, if there is, I sort of suggest that perhaps don't buy it on a common name, buy it on an individual name, his name, her name, irrespective of how many properties are. The loans could be on a joint name, yeah, because you need both of these, sort of the husband and wife, as the guarantee side of it. But must speak to your accountant.
And circumstances all change, whether you're a business owner, a salaries and wage earner. There's lots of different reasons. So there's no one answer fits all. It really comes back down to your personal circumstances. Guys, I'm just going to quickly run through two things. Manjul is going to touch upon 2 different clients. I'm going to touch upon what I think is a perfect property. I'll be very, very quick, I promise. I like to go through with all my clients and work out what the property's actually given you, after tax, before tax, with depreciation, without depreciation. I've highlighted these things in yellow because these are what they call non-cash deductions. You didn't physically have to pay for that out of your back pocket. This particular property is a property, one of my ones. It rents for about $20,400 per year, bit of body corporate, borrowing costs, council rates, insurance, interest, property management fees, repairs, water rates and sundry costs. At the end of the financial year, it is negatively geared from a tax point of view by about $7,062. So the negative gearing on this property from a tax point of view is $7,062. Tax benefit, say 37%, it's given me about $2,612 as a tax benefit. But when I add back the depreciation on plant and the depreciation on buildings, which equates to, say, give or take around about $8,000, that's actually putting $988 cash in my back pocket. But when I also add the $2,600 worth of tax benefit, it's giving me close to $3,500 in my back pocket. So that's the power of obviously making sure that you're claiming everything the right way and you're utilising such tools like depreciation and borrowing costs. So again, a tax benefit has been received on the basis of the negative gearing, but when I add back the deductions which haven't physically come out of my back pocket, that's where I'm getting the extra benefit. I call it a perfect property because I'm getting cash flow genuine from the property, but also getting the tax benefit from the government. It's not going to be like that forever because the depreciation will reduce over time and wither away to something very, very little. But it is good to see while I'm getting a little bit of benefit now, I'll continue to try and get that. Manjul, you're just going to quickly go through 2 client case studies and then we're going to wrap it up for tonight.
Yeah, look, I mean, the typical sort of the question, I suppose, I hear is that do I buy and hold, or do I buy and sell, or what do I do? What is sort of my the own investment goal? It depends on what your objective is in longer period of time, right? So buy and hold is, I suppose, is a strategy that you buy your first property, whether it is through your sort of initial savings, the parental contribution, either way. So you start and you buy your first property. Over a period of time, the asset, hopefully, you bought it well, the asset increases, you utilize that equity to buy your second property. Over a period of time, hopefully both of those assets increased. You use it to buy your third property and fourth and fifth and sixth and so, based on what your investment strategy is, right? It's not number of properties is what I say. It's about the net asset is what I'm after, right? So you need to work it through how many investment properties do I need to reach into my net asset as such. The comment which I want to say is that initially it always that much harder, but it becomes easier over a period of time because of a compounding effect. You've just got one property as such, right? So you're waiting for that property to increase in value before you go into the next one. So it's a bit harder, but it becomes easier and easier over time, provided that you buy the right property, right? Because it's a compounding effect, right? So if you've got a negative compounding effect, we're asking for trouble. So in an ideal world, I love to buy properties which has got manufactured growth potential. So properties which I'm buying it on its own merit, yeah? So I'm buying it on the cash flow. So how much is the cash flow? How much it cost me out of my pocket to hold on to that property? I suppose the trap in there is that very often is to say, well, I'll put in 20% deposit and 80% is the mortgage, I'll calculate on 80%. And the next property, the trap is that I've taken the equity from the first property of 20%, but my mortgage is really 80% on the second property. We use the calculation on the second. Make sure you take all-inclusive cost to know quite clearly how much it cost you. So your entire interest cost, right? All of your holding cost and so forth, and all of your holding costs. The buy and sell, I suppose, is that when you buy a particular property and what you do is that you do a bit of your renovation, you subdivide, you build a granny flat, you subdivide, build another house, and you sort of sell it away. It's exciting, right? But it is problematic. And it's problematic, generally speaking, in the sense that if you don't do it in the right way, yeah? If you do not do it in the right way. I've seen people doing very well in buy and sell. I've seen a lot of people living into fallacy with buy and sell. And fallacy means is that when you buy it and you renovate, you subdivide, you sort of construct, do all of those things. I've done it, Manjul, for about 300,000 that I bought, and I spent about 50 odd grand, so at 350 I sold it for 500 grand. That's good, 150 odd grand. No, because you got to add away the buying cost, you got to take away the selling cost, you got to take away the capital gain tax attached to it. You may not be entitled to a discount because you've done it below 1 year. You got to take away the holding cost. So fundamental thing which I sort of say when you do buy and sell is that the way I sort of do in my mind is that can I afford to hold on to that property if the project doesn't go within sort of my business plan, right? So if the interest rate goes up, if sort of market took a bit of dive, this happened, that happened, that happened, can I still afford to hold on to that property? That sort of is sort of my, I suppose, my sort of a test in my mind. And if the answer is no, then buy and sell to me is rather risky. Many example, I was sitting down with a client the other day. Client bought a property about 22 years ago, somewhere in Sydney without in details for about 170 odd grand, about 22 years, and that's probably sitting at $2 million market value at the moment. Not bad. And if I give you the name of the suburb, if I give you where it's being purchased, you say, yeah, 2 million makes sense. That's what the market value is, right? And it's nothing extraordinary. It's about 500 square meter land. It's a corner block. It helps. In that area, 500 square meter land, it helps. The house is probably not the best of the condition. It's okay. So I can give you that example. I can give you an example that is CGT event that we done recently. Gentleman bought a land for about 538,000 or so. This was about 25 years ago as well. Believe it or not, they sold it over $13 million. $13 million that they have sold it. Why? Because the whole area has been rezoned. So to me, this is a good example. I can give you the contra example that a gentleman of our client, good client, right? So he bought a property a number of years ago for about 1.1 million in Bondi. And he sold it literally within a year, touch with over a year, for about 1.7. And he said, he's done well, 1.7, you know, why would you complain? 500 odd grand within 1 year, brilliant, right? He loved it. I loved it too. The problem is the value of that property is about 6 million now. But he's done well with his 500,000 or 600,000, right? And there are many other examples, right? I can give an example of a 5-acre land in Leppington as an example that someone bought it for 380, sold it for 930, literally within a year or so. And that 5-acre land, depending on where it is in Leppington, it's probably easily about $5.5, if not $6 million at the moment is the market value. So what's the sort of I suppose, basic tip that I take? I say that very often I make more money in terms of not doing anything, in the sense that holding on to it. It doesn't need to be that exciting. We don't need to buy and sell as such. Very often that inaction where we hold on to it for a longer period of time, provided that we continue with our investment journey, provided that we can still get the funding and we can use that funding to purchase the subsequent property, provides bigger benefit.
Beautiful. Thank you very much, guys. Thank you. We'll get Ross to just wrap it all up for today. Thank you very patiently for listening.
All right, you've got everyone's got these forms on there. We want feedback for tonight on the topics. What are the things we can do to improve? Future topics that you guys would like to hear about. Munzrul touched on a lot of different strategies there to sort of pique your interest. If you want to know more about those or something else entirely, let us know. Scott's offered to provide his spreadsheet to anyone, obviously without his numbers on it, to anyone that wants it. So just write down the bottom that you would like to be emailed Scott's spreadsheet, and he can send that over to you. And if you want to be contacted by a broker, by the guys from Keshab, or we've got a number of buyers agents that we can put you in touch with to help you with your next purchase.
Let us know what you want to hear as well, guys. We're very flexible. We love to make sure we're being informative. So please do put some recommendations down of what you would like to hear, and we'll definitely take it into consideration and hopefully come up with a presentation or seminar for you, maybe for your query.
For a bit of fun, death, taxes and childbirth, there's never any convenient time for all for any of them, all right? Definitely.
But I was joking with Jeremy today when I saw that slide. I'm sort of building our own home, the principal place of residence, and I said that perhaps we should add away a fourth one, death, taxes, childbirth, as well as building your own home.
Exactly.
There is never any convenient time.
Munzrul was talking about his house blowing out the budget, and I've recently done a renovation where it blows out the budget. So,
I'm still shocked that black taps cost more than chrome taps. I always thought chrome was more expensive, and then I worked out that black taps were so much more. I'm definitely learning lots about the trade-offs, of chrome and black.
Black will go.
Oh, mate. Oh, God.
So next seminar is going to be teaching you how to research like a pro, and give you lots of good advice on how you can do your own research, because even if you use a buyer's agent, you need to be able to research and do your own due diligence on a property as well. So you're going to be teaching that, potentially have some guest speakers along as well. So put that in your diary for the 19th of June and bring a friend along. Thanks, guys.
Beautiful, thank you.